If you make more than $144,000 as an individual or $214,000 as a married couple filing jointly, you should be doing what's called a backdoor Roth conversion. So a backdoor Roth conversion is a way that you can contribute to a Roth IRA even though your income exceeds the Roth IRA thresholds. Let's take a look at how this works. A Roth IRA in a traditional IRA. So an IRA stands for Individual Retirement Account. So you can contribute up to $6,000 in each of these accounts each year. So you can do $6,000 contribution. So how this works is if you contribute to a traditional IRA, typically you get a tax deduction on that $6,000, meaning your taxable income, let's say it's $100,000, would lower to $94,000 by the amount that you contribute to the IRA. Then, so the benefit of this is all the money that goes into that IRA grows and then is basically tax-free while it stays in this bucket. Once it goes out of this bucket, there is tax. So you get taxed once it comes out of that IRA. So when you take a distribution, as it's called. A Roth IRA, you can contribute the $6,000 as well. That $6,000 comes into the Roth, still grows tax-free within the bucket, but then when you take it out, there is no tax. So you don't have to pay tax when it comes out of the Roth IRA. So why is this beneficial? So basically, if you use a Roth IRA versus a traditional IRA, and you're starting early, you're making lots of money, and you're contributing the max or close to the max along the way, this literally could save you hundreds of thousands, if not millions of dollars throughout your career by utilizing a Roth IRA instead of a traditional. However, if you have more than, I'm just going to use a single person as an example, if you make more than $140,000 or $144,000, you cannot contribute to a Roth IRA directly. If you make less than $144,000, you can. There's varying amounts you can contribute. So you can't, at say $140,000, you can't do the full amount, but that's sort of outside the scope here. So basically, if you can't contribute to a Roth IRA directly because you make too much money, how do you go about doing it? So what you do is you actually make a contribution to a traditional IRA. So let's say we're going to make that $6,000 contribution here. It is going to be what's called non-deductible. So basically, you cannot take any tax benefit on that contribution to the traditional IRA. So you now have that $6,000 in here, but you had no tax implications, you got no tax benefits. So if you made $100,000, you're still making $100,000. So then we're going to do what's called a Roth conversion. So we're going to basically convert that $6,000 to a Roth IRA. So then it converts, and now it's in the Roth IRA. So, however, in that situation, there was no tax implications because you didn't get the tax benefit here, so there's basically no taxable income. So this is the backdoor Roth piece of the puzzle, so the backdoor piece. However, let's say you have the $6,000 in the shelter, and then you have it invested and it actually goes up to $7,000. So you have $7,000 that you now convert down here. Well, there's that difference of $1,000 between the $7,000 and the $6,000. So that $1,000 difference is taxable because you got tax benefit, you got tax-free growth there. So basically, if you then do that conversion, you would have a basically $1,000 additional income, and then $6,000 that basically passes through no tax. So this is a simplification of the procedure, but basically, this is an easy way to get more money into a Roth IRA, even if you make too much money. So this is a strategy that's been talked about getting, kind of closing the loophole. So if this is something that, you're young, you're a millennial, and you want to start bolstering your retirement funding, this is a really good strategy that you could be implementing today. And there are some nuances, so definitely work with a professional if you're going to go through with this. But long story short, this is a strategy that can really work if you're making decent money. Cheers.